Let's bring in CNBC contributors, Payne Capital's Courtney Garcia, and Capital Area Planning's Malcolm Ethridge, Maryland Bank of America Private Bank's Chris Heisey, also, of course, still with us, and welcome. So, Courtney, you know, it's interesting because you have the market locked into this mode of we're going to get a pickup in growth, it seems anyway, and yet the interim data don't always agree with it in terms of you know, what's going on with some consumers and also the jobs market. Reminds me of what was going on in September, where it's like, oh, the Fed's going to cut into a decent economy, and then we have a little bit of a scare. How are you thinking about how that all fits together?
Yeah, and we keep getting this data that is conflicting, and so I think you have to really look at this as an aggregate. But I think when you're looking at labor data, this is showing that you could potentially be having a weaker labor market. That is different than having a weak labor market, right? I mean, I think we're in this stage where we're not having mass layoffs, you're also not having a hiring spree. We're kind of at a standstill. And meanwhile, the consumer, broadly speaking, though there are pockets, which we've talked about, which aren't holding up well, broadly speaking, the consumer is holding up. You're seeing GDP for the third quarter is tracking at 4%. The Fed is likely going to cut interest rates, and with this report that came out, it's probably even more likely that they're going to do so next week. All of that just leads to more likelihood that the markets are going to run up further from here. And I think all of those things are really what you have to look at.
It's interesting because we're in this spot where we are forced to cite third quarter GDP, right? That quarter started 5 months ago.
Yeah.
You know what I mean? So we're sort of in this blackout window, and on a given day, Malcolm, the market is willing to give a pass to the immediate concerns because maybe things are about to pick up. How do you think about it? And just in terms of, you know, the earnings trends you're looking at, even how dependent is your portfolio on what the underlying economy is going to do?
Yeah, so I think it's hard to separate the overall economy, as you said it, from AI and what's been happening within the Mag 7, as you guys started out talking about, because they really go hand in hand now, right? Half of all GDP growth this year has come from those investments, all those dollars being thrown into the dirt, so to speak, to build out AI infrastructure. That all is really building and growing the economy right now, and without it, we're stuck. And so I think it's unrealistic to be able to extrapolate out how much we expect to come from all the other sectors next year. We have to consider that this trend is going to continue into 2026 and beyond. There's been way too much investment made at this point for it not to. And I think the real question is just how productive are workers going to become next year and beyond, as you guys alluded to. And that's really where we as investors should be trying to place our bets.
Now, you do, Malcolm, look at, you know, a lot of these big growth businesses that are making a lot of these investments. So who seems better positioned now versus maybe a few months ago? And how actively do you have to, I guess, sort of change your thought on that?
Yeah, what's interesting is up until about a month ago, we really thought we knew who the dominant players in this space were going to be. It was NVIDIA, it was Microsoft, it was Oracle. It's anybody who was closely related to OpenAI and Sam Altman. And you said a month ago, and I think it was exactly a month ago, when the interview with Brad Gerstner and Satya Nadella happened, where Sam Altman sort of brushed away the questions about their spending commitments versus their current revenues. And that's what really created this shift. And so now the companies that are closely related to OpenAI are the ones that have been punished the most. And investors have been sort of lining up in other places, Amazon, Alphabet, elsewhere, trying to figure out ways to still be invested in the AI trade without having to be so exposed to OpenAI, just in case we find out that our willingness to suspend our disbelief around what they're building there isn't going to be punished long term.
That is perhaps, Chris, a risk if you're looking at how a client's positioned, whether actively or just by the way the market's performed. You have an implicit bet if you own the core of the equity market on these trends continuing, even though, I mean, bank stocks have done great. You know, there's other parts of the market that have certainly done more than their share. So do you look to rebalance around that? Do you look to sort of lessen that bet, or just assume that you want to keep participating at that level?
Yeah, that's a great way to characterize it. Just by having a core allocation, even if it's just in the S&P 500 and you're a diversified investor that just keeps adding to it, you're 44% exposed to telecommunication services and information technology. Not to mention, you know, the agentic AI movements in other sectors like industrial. So I think you have to be cognizant of that. Look for opportunities to upgrade healthcare. Look for opportunities to diversify to non-dollar assets. I know we've been talking about that for a while. It doesn't appear that non-U.S. developed or emerging markets are just going to have 1 year of outperformance. It appears that every region of the world is growing their deficit to create a domestic growth curve in their economy. That just doesn't close itself in 1 year. So we would suggest if you had a 0 to 10 diversification scale, 8, 9, 10 is where you want to be on that scale heading into 26, 7, and 8. Precisely with what Malcolm said about who are the winners, who are the non-winners. I think we shift to this cycle, Mike, where efficient use of capital across all sectors and industry and groups is now just beginning, and the cost line is what we're going to be looking at. What's happening there and how is it helping margins?
Courtney, one of the bullish talking points coming into this December in particular, especially after the little 5% shakeout we got in the S&P 500 is we've reset positioning. People aren't exposed enough to the market if we're going to get a levitation into the end of the year. Does that feel like it fits with what you're seeing in terms of your investors and how the market is acting?
You know, I'd actually almost find the opposite. We've really been working with investors on taking profit just because there has been such a run up this year, especially if you haven't made changes. You have probably too much in AI at this point. You probably have too much in like certain areas that are over concentrated. And so this is a great time to start to take some of those profits. And you bring up some good points like international, for example. I know we talk a lot about the S&P 500. It's doing really well, not nearly performing as well as international has this year. And I agree with you. I don't think this is going to be a one-year thing. And so I think you want to take some of those profits. And then you have clients in places like New York City where you have high income tax, and municipal bonds make a lot of sense there, where if you're going to start to take some off the table, you look at a 4% muni yield. That's the tax equivalent of like 8.4% if you're in the highest tax bracket here in New York City. So there's a lot of really good opportunities that I don't think this trade is over, but take some profits and spread it out over everywhere else. And that's really what we're looking to do right now.
Chris, I love your thought on that, too, because I think a lot of it focuses on like tactical professional investors. Maybe they don't quite have their max allocations and things like that. But, you know, I look at data from your firm, as a matter of fact, you know, the private client equity allocation, just because the market's up, they're pretty much in.
That's right. No, that's another good read. You know, there's surveys are surveys, right? In the day of sentiment switching based on the headline that's out there, but when you look at the real data, it makes sense that equity allocations are at all-time high. And the fund manager survey that BofA Global Research puts out as well says one of the lowest cash allocations as well. But when you look at the amount of cash overall, it's at its highest level ever because you were earning cash flow on your cash. So what do? Courtney's right. You actually take the time, take the calendar, take the capital markets when they give you the opportunity to rebalance, even though it doesn't feel good doing it at the time. Take that opportunity, diversify. If you can take some profits, obviously harvesting losses, not just at the end of the year, throughout the year makes a lot of sense. And that is, you're being an active investor every day, every week, every quarter, not just, like you said, you know, the professional investor who sits back and says, well, what should I own today?
Yeah, exactly. And Malcolm, what about some of the rotations that have happened within the market already, right? You see this resurgence in healthcare, so it's not all the most aggressive, growthy stuff that's been really firing right now. Does that entice you? Or you seeing other things that are being left behind that look like they're worth a bet now?
Yeah, so I have been paying attention to what's happening in healthcare. That was a missed opportunity for probably a decade. Any money sitting in healthcare was just kind of stagnating at best. And I think that investors have been looking there as that's the place that the growth is expected to come. That's also a sector that's likely to be disrupted extremely well by AI going forward. And so it makes perfect sense that that's a place that you will be wanting to place your bets. I have also been banging the table on cybersecurity pretty aggressively for the last couple of years. Anyone who will listen to me knows that I'm very focused on that sector because I think two things are going to happen. One, there's consolidation coming in the space. There's just not enough cybersecurity engineers out there to meet the demand that exists, and so companies are going to have to acquire smaller companies. But I also think the standalone cybersecurity firms are just digging in their heels even deeper. And so with CrowdStrike pulling back post-earnings, I added shares this morning at the open. I bought additional shares of Zscaler when it sold off following their earnings. I think that's a sector that is ripe for additional growth coming out of 2025 and into 2026, because as we talked about agentic AI being a thing that we should be excited about as investors, it's also a thing that cybersecurity firms, I guess enterprises globally in general, are terrified of because you have synthetic AI threats now, and that has to be guarded against. So it's a great opportunity for investors in that space as well.